Hi everyone, thanks for joining us today. On today's series, we're going to be talking about the revenue recognition for for-profits and nonprofits, because you kind of have to understand both. A little bit about the nonprofits relates to the for-profits, so we're going to talk about both today.
So let's start off with for-profits. Makes most sense. So a typical for-profit, you recognize revenue when you perform a service, you sell product or goods. So let's just go to the example. And April, I'm going to use you as an example. Congratulations.
Okay.
So let's pretend, hypothetical speaking, you never done this before. Let's say you pull out your Target app on your phone. 'Cause like I said, never done this. And you made a purchase for something at Target. Right there for Target, that's revenue recognition. April went on their phone, bought the product from Target. Target now has a sale. They're going to be recognizing, they will receive money, consideration. April gets something in return of equal value. For a for-profit, that right there is revenue recognition, an exchange of equal value on both parties. Now, some nonprofits do have those kind of services. Program fees, let's say they're offering classes, they're charging for those classes. The consumer is getting something in return. They're getting a class, the nonprofit's getting the fee. So nonprofits do have what we're calling for-profit revenue. However, there's a whole other world, and that's the nonprofit side of things. Then it's talking about grants and contributions. So April, you want to jump on that one?
Yeah, they've actually created this separate rule, these separate revenue recognition guidelines around grants and contributions because they are so specific for nonprofits. A lot of times with a nonprofit, the funding source is not the person that's getting the benefit. You have grants and funders who are funding your mission, but your consumers are really receiving the benefit. So the rules around that are very specific. First, you would start with recognizing whether or not the grant is conditional or unconditional. So a condition is a little more strict than a restriction. A condition is when you have either a performance barrier and a right of return. You have something that you need to do in order to be able to recognize that revenue. So an example of that would be a certain number of meals that you need to deliver if you had a program centered around meals for those in need. Another example is a matching requirement. So if you have a match on a grant and you need to raise $100,000 to meet that grant requirement, until you meet that match and raise those additional funds, you're not able to recognize the revenue until the conditions are met. So those go a little beyond the restriction piece. When a grant is unconditional, that's when you then need to look at whether or not it's for a specific program, if it has a program restriction to it or a time restriction where it may be something that you need to use the money in the next year. That would be an example of a time restriction. So the accounting guidance does give you a little flow chart, kind of goes through whether or not there's an exchange transaction or not, whether or not it's conditional or unconditional, and whether or not it's restricted or unrestricted. So those are the steps that you're going to take for the revenue recognition. But one of the things that always confuses everyone is if you remember the matching principle for revenue and expenses being in the same period, that matching principle has gone out the window now, especially with the grants and contributions. So a lot of times you take in that revenue and you have to recognize it, even if you're not spending it until the next year. Either you're spending it next year on next year's program, you're spending it on next year's summer camp. In those situations, you have to recognize the revenue if it's coming in from a grant agency or a grant or contribution. Sometimes you have to recognize that revenue when you get it, not necessarily when you spend it. So that really confuses everyone, I think, in the revenue recognition world. And I think, like you said, Adam, one time somebody had asked, "Why is my grant on the balance sheet?"
It's true. True story.
That's why sometimes your grant has to be recognized on the balance sheet before it can be recognized in revenue. So we hope that gives you a little bit of insight into revenue recognition for nonprofits.
Take care.